Hello, everyone. I'm Coralie Pledger, Chief Financial Officer at the Austin Community Foundation. Welcome to the Foundation's first investment webinar of 2020. We host this webinar twice a year to keep you informed on our investment performance, changes in the market, and our long-term investment strategy. Before we get started, I'd just like to say thank you for being a part of the Austin Community Foundation. Thanks to people like you, we collectively granted approximately $37 million to nonprofits in 2019. I'd also like to recognize our Investment Oversight Committee for their work on behalf of ACF and fund holders like you. Our investment committee is comprised of seasoned investment and business professionals drawn from our Board of Governors and the larger business community. With the aid of our investment counsel, DiMeo Schnieder Associates, the committee formulates the investment policy, determines strategic asset allocation and choice of asset classes, monitors and evaluates investment performance, and makes changes in policy and portfolio distribution. Now, I'd love to turn things over to Joseph Skeim, Senior Investment Consultant at DiMeo Schnieder Associates.
Thanks, Coralie. Very much appreciate the time today. We always love the opportunity to connect directly with fund holders to let them know what's going on, not only in markets, but also what's going on in the investment pools here at ACF. We're going to spend a few minutes today talking about 2019 in review and how great of a year it was. And then importantly, we'll spend a little bit of time at the end of the webinar talking about our 2020 outlook moving forward, because as we all know as investors, what's happened in the rearview mirror is great, but we want to make sure that we're looking out of the windshield as we're driving the car moving forward. So I'm going to park here on page 3 and look at 2019 in review, and we'll start there. And I think the first thing that strikes us as we look at this chart is how strong a performance it was in 2019, regardless of the asset class that we were looking at. For those of you that have participated in this webinar before, this chart looks a little bit different this time around than it did, call it 6 months ago, as we reformatted a little bit. But essentially, those circles in each asset class represent the quarter return for the fourth quarter of 2019. And the bars that are all pointing straight up represent the full calendar 2019 performance in each individual asset class. And I think, again, from a high level perspective, if we take the 30,000-foot view, we can see every one of those bars pointing in positive territory to a pretty strong degree as well. And, as we think about what 2019 brought, coming off of a 2018 scenario where we had a lot of volatility in markets at the end of the year, I think there'd be a lot of people that'd be very happy to see these bars considering where we were coming off of in 2018. And really, there were two really main themes kind of across the board here that drove market performance. I had someone ask me the other day, if you could boil down 2019 performance into 2 sentences, what would they be? And for those of you that have any connection with the investment profession or ever turn on CNBC, 2 sentences is very hard to talk about investments, but the spirit of what we're trying to do here as we provide updates to fund holders is very much in that vein. Let's take that consolidated view and not talk for 2 hours on something we can talk about for 5 minutes. So the first theme I would say, and this really set the backdrop for 2019, was the Federal Reserve and their interest rate policy. If we rewind back about 12 months, probably 14 months, if you look at the end of 2018, as I mentioned before, remember the Fed had raised interest rates 4 times over the course of 2018. And that last interest rate increase in December of 2018 was really what spooked equity markets, and we had the large sell-off in the fourth quarter of 2018. There was a big shift in policy even before the end of the year, and it really translated through to 2019, where the Fed realized that they probably raised interest rates a little bit too much too fast. And so they've reversed course and said, we're going to be accommodative and continue to do what we need to do to make sure that the economy doesn't sputter in the bond market in terms of the things that they control. So that shift just in sentiment, even before they did anything from an action perspective, really turned things around early in 2019 for markets. And you saw a nice relief rally, as we call it, in early 2019. And then lo and behold, over the course of 2019, the Fed actually cut rates 3 times, a quarter point per per rate cut. So basically they cut them 0.75% over the course of 2019. And that backdrop really is what drove a lot of markets, not only on the bond side. So if we look at the blue bars on the left side of the page here, these are the different bond asset classes, but on the stock side as well. So the sentiment of lower interest rates for longer really kind of gave some confidence to the market after resetting expectations over the course of 2018 to say, look, if rates are going to be lower for longer, that means good things for the economy, good things for businesses that aren't going to have these high interest costs from interest rates going up. And so that positive sentiment really spread through to really all asset classes. And so when you look at bond returns in the blue bars here, you can see something like core bonds. So think of this as your investment grade, very high quality, kind of plain vanilla bond. To be up 8.7% in the course of a calendar year is about 3 or 4 times what we'd expected in one particular calendar year in that asset class. And so that's really indicative of where we saw interest rates go. So interest rates were basically cut in half if you look at a 10-year treasury over the course of 2019. And because bond prices move inversely to interest rates, so when interest rates come down, bond prices go up, you saw really strong performance even from those investment grade bonds at almost 9% for the year. If you look at something that had a little bit more risk associated with it, so the high yield bond space, so think of these more affectionately known as junk bonds, typically trade a little bit more like stocks do. And so up 14% for the course of 2019, really speaking to that, what we like to call the risk on mentality. Investors not worried so much about risk, but really wanting to try to generate returns. And that really spilled through to the other parts of the portfolios and parts of the markets that were, again, kind of on the risk side of the equation. So stocks in the middle of the page here. So everyone knows the U.S. large cap, the S&P 500. So up almost 32% in 2019. Just a very strong return. And that's been a pretty consistent theme, as we'll see later on here in U.S. equities and how strong those returns have been. Small cap companies represented by the Russell 2000 up 25.5%. But even some of the asset classes that tend to get a little less love from the media, so international developed countries and emerging market countries had a really strong year as well, up 22% and 18% respectively. And when we look at, we talked a lot about these year-to-date bars, but if we look at these circles in the middle of some of these bars, one of the interesting ones here is emerging markets. So if we think back to the second theme of what we saw over the course of 2019, there was a pretty large overhang over markets, even in spite of this positive performance of the trade negotiations between the U.S. and China. And so they're seemingly on a day-to-day basis or a week-to-week basis, whatever was going on in the news between the U.S. and China, if they were getting closer to a deal, the markets were up. If talks were falling apart, the markets were down. And so that kind of that overhang was over markets, particularly in the emerging market countries, for some period of time over the course of 2019 until we hit December, when the U.S. and China agreed to what they call phase 1 of the trade deal. And in that particular period, the last 2 weeks of the year were really strong for emerging markets. So as we continue to think about globally diversified portfolios, as strong as the U.S. markets have been over the last decade, we do want to make sure that we continue to maintain allocations to these foreign assets that haven't done quite as well, but still have a lot of embedded value in them in terms of what we think they can do for portfolios and in the markets moving forward. And then lastly, on this chart on the far right side here, these light blue bars, these are the real assets, or what we tend to think of as inflationary type hedges. So U.S. equity REITs, so real estate investment trusts, publicly traded real estate essentially, up 26% for the year, although relatively flat for the fourth quarter. They tend, just similar to bonds, they tend to do really well in a declining interest rate environment. And so that's what we saw over most of 2019. And that boosted their returns pretty significantly, and a little bit more than on the bond side, because they are equity securities or stock-like securities in how they trade. And then the other piece of a lot of these portfolios for ACF would be the midstream energy space. This is really concentrated in the long-term active pool, but up 6.6%. So those pipelines that are transporting the oil and natural gas, another piece of the portfolio that tends to be very high yielding, but also has some inflation protection built in as well. So again, strong performance on a year-to-date basis. Maybe not quite as strong as other asset classes, but as we'll talk about in our 2020 outlook, that means they have a bit of a higher expected return moving forward. So that's the 2019 year in review. Obviously very strong, continue to see strong fundamentals. I would say growth is probably slowing a little bit as we look at the outlook for 2020, and earnings are slowing down a little bit, but things are still moving along pretty well, where 2020 could very easily be another good year, although we don't expect another plus 32% on the S&P 500 as we sit here today. The case for diversification on slide 4 here. So this is our profession of humility, as we like to call it. So if you look at these different asset classes, so these are calendar year returns and all the different asset classes that we just looked at on the previous page, where do they fall? And you tend to see these boxes jump around quite a bit. So the light green box towards the top and then towards the bottom, some of the dark blue boxes, again, top, then bottom. We're really shooting for what's in the middle here, this yellow, or what we call balance. So this is a mix of all those asset classes, and why we diversify is because we're trying to get more smooth in how we see our returns in the portfolio. So we don't want to be at the top, because the things that are at the top tend to be at the bottom the next year. And if we can pick which ones are going to be at the top or the bottom in any given year, that would be the ideal scenario. But that's why since we don't have that crystal ball, we don't know where those asset classes are going to be. And so again, that profession of humility, that we don't know what's going to happen in markets, so we diversify amongst a number of different investments to try to smooth that ride along, and ultimately end up in this yellow box here towards the top, but certainly above the middle over long periods of time. With that, I'm going to jump right into performance of the different pools at ACF. So this is the performance of the long-term active pool, and all of these are as of December 31st, 2019. So you can see the strong performance that we saw across the board in 2019. Just for the fourth quarter alone, the long-term active pool was up 5.37%, right in line with its benchmark of also 5.37%. And then for full calendar 2019, just over 19% in terms of net returns for the long-term active pool, a little bit behind that benchmark. One thing that we like to point out with benchmarks is that benchmarks don't have any costs associated with them. So anytime you go and invest in some sort of stock, bond, or mutual fund, or whatever it might be, there's a cost associated with it. So the overall cost of the long-term active investments is right around 0.63%. So think of this as a net versus gross a little bit. So even though we're a little bit behind the benchmark for calendar 2019, and even over the last 3-year period, you can start to see that over long periods of time that normalizes out, and those active managers end up adding value above and beyond that cost. So 8.33% over the last 3 years, 5.86% over the last 5 years, and then over the last 10-year period, annualized at 6.32% per year on the long-term active investment pool. So again, very strong returns for 2019, and a really good period over the last 3 years, even in spite of a 2018, as I mentioned earlier, that was a little bit difficult towards the end of the year. In terms of asset allocation for the long-term active pool, so here are how we sit today. This was, again, as of December 31st. So you can see the total current allocation columns and the various asset classes, bonds at the top, stocks in the middle here, and then things like hedge funds and private equity that are a part of the long-term active pool here towards the bottom. And you can see generally in line with targets. I would say the changes here, or not changes, but the differences or the delta here is that underweight to bonds and overweight to stocks, and that's simply a function of market movement, right? As stocks have done better than bonds, even though bonds have done very well, stocks have done better, and so you've seen a bit of an overweight to stocks just as the portfolio naturally drifts, and so that's a great time to rebalance back to our strategic targets. We buy low and sell high, so in this case, we're going to be selling high on those stocks and buying the bonds that didn't perform quite as well as the stocks and by design, and so that was something that in the last investment committee meeting with ACF, we decided on what that rebalancing should look like. So we looked at our strategic targets and we said, yep, it's time to rebalance. And so that was all incorporated into our 2020 outlook, which we'll get into here in a second as well. But again, this is exactly what the investment committee does, is to look at our allocations and say, are we at our targets? Should we be at different targets? Is it time to rebalance the portfolio? So all those decisions are getting made in the quarterly investment committee meetings. Jumping into the long-term passive results. So if you look at results here again as of December 31st, you can see the long-term passive pool up 6.8% versus the custom benchmark of 7.2%. And then for calendar 2019, up 21.19% versus the 22.38%. So a couple of things to note here in terms of the difference between the long-term passive and the long-term active, just from a performance perspective. Remember that the thing that did the best last year, the asset that did the best was U.S. stocks, those large cap stocks, and the long-term passive pool has more of those than the long-term active pool does. So about 27% in long-term passive versus 20% in long-term active. That's because the long-term active has some additional asset classes like those hedge funds and the private equity and the midstream energy that are designed to have a little bit different risk and return profile than this long-term passive pool. So in the great up market that we saw in 2019, that meant better returns for long-term passive to the tune of almost 2% if you look at the 21%. But on a relative basis, and this is where the difference between active and passive comes in, is that we were a little bit further behind the benchmark because of the costs associated with the investment plan, and knowing that by design, the passive pool is meant to try to track the index, not beat the index over time. So if we look back now since inception, February 1st of 2017, you can see very strong performance, right? 9.44% per year over that period of time, but behind that benchmark of 10.11. And we should expect that we will always be at least a little bit behind that benchmark because of the passive nature of the pool and what it's trying to do, seeking to replicate the index or match the index minus expenses, as opposed to trying to beat the index over time like the active pools do. From an asset allocation perspective, so again, as we look at long-term passive here, you can see we're basically right in line with our targets. So 20% in bonds and 80% in our stocks. So again, still a similar 80-20 mix to the long-term active, still 20% in fixed income, but that 80%, what I'll call the risk-seeking bucket or the return-seeking bucket, was a little bit more allocated less to the hedge funds and private equity and midstream, all to pure global equities. There are also some additional cash flows that came into this portfolio just before year end that allowed us to kind of rebalance right back to the targets ahead of the investment committee meeting in February. On the midterm active pool, so you can see a different allocation. We'll talk about the allocation briefly here, but up 5.45% for the fourth quarter of 2019 and up 18.9% for calendar 2019 overall. So again, a little bit of outperformance relative to the benchmark in the fourth quarter, but a little bit behind the benchmark over time in 2019. And this portfolio is a little bit newer, so a little bit over a year in terms of performance. So it has underperformed that benchmark slightly by about the cost of the investment plan. And we would expect that over time that those active managers will start to add value, just like we saw on the long-term active pool over 5 and 10 year periods of time, looking to beat that benchmark over those periods of time. What does the asset allocation look like? This is where what we call our quote unquote 60-40 portfolio. So 60% in stocks, 40% in bonds. You'll see a little bit of an overweight to cash. This was simply due to some large gifts into the pool right on December 31st. So folks racing to get those donations in before tax time. And so this was naturally rebalanced. That cash was applied across the board. And if we looked at this snapshot today, as opposed to December 31st, we'd be right at those 60-40 targets. Midterm passive. So same asset allocation as midterm active, but we're just implementing the passive manager. So a very similar theme to what we saw on the long-term side. So 5.27% for the fourth quarter, a little bit behind the benchmark as we expect. And calendar 2019, again, a little bit behind the benchmark. This pool has been in place a little bit longer than the midterm active, but if we go back to 2017, so 3 years worth of performance annualized at 8.29% versus the 8.76% on the benchmark. Again, exactly what we would expect to be tracking pretty close to the benchmark minus expenses over time. And lastly, again, a similar theme here where we had some cash come into the portfolio right before 12/31 or on 12/31, so cash at 3.5% versus the 2% target, showing a little bit of an underweight to some of these bond asset classes that was reallocated and basically right in line with our 60/40 targets that match more of a medium-term time horizon than the long-term pools. I'm going to spend the last few minutes talking about our 2020 outlook. And it's important because as we sit down with the investment committee and talk about what changes need to be made, again, as we look in the rearview mirror, 2019 was great, but what do we expect in 2020 moving forward? So this chart shows DiMeo Schneider's expected returns by asset class year over year. And so it tends to be a little bit scary when you see a lot of red on the page. We are not expecting negative returns for 2020, but we look out over a 10-year time horizon and say, what is our expectation? And so the column here, 2019 to 2028, shows what our expected returns were on these various investments a year ago. And now, after a really strong year across the board, what do we expect moving forward? So the natural implication of everything being up to a strong degree means that we don't think we can earn the same amount of return moving forward over the next 10-year period. So bonds come down pretty significantly in terms of expected return. And some of you will probably see that in your cash yields on what you can get on money markets. It used to be, over the course of 2018, it was actually a pretty good environment. You could get over 2% on cash. We're back down to a much lower degree here. So you can see that reflected in not only bond expected returns, but cash and other things as well. And then equities. So stocks globally did really well. And so you see a reduction in expected returns there as well. So you tend to see, again, in good years, the forward-looking returns are a little bit less. And in difficult years where you have down markets, these bars all go the opposite direction and things get green. And that's part of the process of being iterative to say, we want to make sure that we're not burying our heads in the sand. We're taking into account what's going on in the world to make sure that we're making adjustments to the asset allocation as necessary. And again, that's something that we do as a firm, DiMeo Schnieder, to try to make these adjustments in collaboration with the Austin Community Foundation Investment Committee to understand, do we need to be making tweaks here or there, or there's something that we need to be doing drastically different? And in most cases, it's not drastically different. It's more of, yes, we need to move a little bit here, move a little bit there to make sure that we're keeping up with what's going on in markets on a year-to-year basis. And so what does that mean for 2020? So these expected returns are down. We've talked a little bit about economic data slowing down a little bit, earnings slowing a little bit. What does that mean for portfolio implications? Should we be expecting a really choppy market, or should we be expecting the next bear market or recession to hit sometime soon? And we found this chart here on page 14 that we thought was really interesting. And what this chart shows is the return of the S&P 500 since the bottom of the market back in March of 2009, which is now a full 10 years in the rearview mirror and some. And what's really interesting here is this was titled Reasons to Sell, and we called it Climbing the 10-Year Wall of Worry. All these different events that have happened over the course of the last 10 years that everyone thought was going to derail the bull market, or you can make the case thought as that they were thought that they could derail the bull market. So if you look back just as early as March of 2010, the BP oil spill, I'm just going to pick a few here that will probably stick out in people's minds. That was really scary to think, wow, we're just coming out of the recession. What's this going to mean for global markets? What is this going to mean for energy stocks, et cetera? And you can see a blip on the radar, right? Markets went down, but ultimately started to trend back up. The fiscal cliff, you might remember from the end of 2012, what happens if the U.S. government goes over the fiscal cliff? What is that going to mean? Are things going to fall apart here in the U.S. and we're going to fall into recession? Again, a little dip and then a really strong march back up. What's something that's more apparent or more applicable today, the Ebola virus contagion fears. And when we talk about what we hear about the coronavirus today, could be a similar parallel. Ebola virus right here, that was a very scary piece of information and a scary epidemic that was going on around the world. And ultimately, the markets ended up shaking it off and moving a bit higher on the fundamentals. The Dow falls 1,000 points for the first time. It was a big deal back then because 1,000 points, it had never happened before, those 4 digits. But the Dow had grown to a degree where that 1,000 points was not that big on a percentage in percentage terms. And so you continue to see the markets climb higher after good earnings and good economic data. The U.S. government shutdown over here, there's actually a couple of those on this chart. So all of these things that have happened over the course of the last 10 years, if you took them as headlines, as reasons to sell, there's a lot more return that you could have missed out on. And so that's what this number here in the top right, 495%, if you just kind of stuck with the S&P 500 over that 10-year period of time. Now, the easy thing to take away from that is, well, shouldn't we just have all our money in the S&P 500, right? Clearly, you're saying that this isn't going to affect us. Anything that pops up as a headline, we should just ignore and kind of, again, bury our heads in the sand and wake up in the future and have great returns. And I think we're cautious about that sentiment. We're certainly cautious about, just because we've got headlines doesn't mean that we should be worried about the market. But also, in the same time, we want to make sure that we're not overly optimistic on something like the S&P 500. This is, again, a 10-year period that's relatively been unprecedented in terms of how strong these returns have been and how consistent they've been. So we want to make sure that we're being thoughtful that it will be something that's more data-driven. There's going to be true economic change, or there's going to be true earnings change that's going to drive the next bear market, not the headlines that we typically see. And I'll mention again the coronavirus. We never want to minimize the human impact of something like that. That's obviously a very sad story to think about the families that are affected overseas, and it's starting to happen here in the U.S. a little bit as well. But in terms of, as we try to think about it as objective investors, do we have precedent that we can look back on, and what does that mean? And the most applicable thing to think about is, remember back SARS back in 2003. That was a very similar type of epidemic, and I know that the numbers have kind of exceeded what SARS was here for the coronavirus, but the economic and market impact was short in nature, and then ultimately after the impact, you actually saw a strong recovery coming out of that impact to the downside. So in terms of, do we make any changes to investment portfolios based on things like this? The short answer is no, but certainly a situation to continue monitoring if it starts to kind of bleed into the actual economic data as opposed to the headlines that are driving a lot of the kind of the fear in markets today. And what's interesting is, if you look at where you'd think that, as much as this has been concentrated in China and all the headlines have been from China, Chinese stock markets today are actually flat for the year. So they're not down 10, 15, 20% as you might expect if we're in this epidemic. So it kind of tells you there's a disconnect between the headlines that we see and what drives markets in the long term, just like we see in this chart on the reasons to sell. Closing thoughts for 2020. So again, we want to make sure that we're being cautious. So where there's a case for caution to say that we don't expect that we're going to see the same returns that we saw in 2019. We're also going into an election year that will obviously typically include some additional volatility for markets, and we'll talk a little bit more about that on the mid-year webinar here in 2020. But caution doesn't mean imminent doom, right? So we don't think that things are going to fall apart tomorrow and all of a sudden we need to be bracing for a bear market or a correction in the next week or the next 6 months, whatever it might be. Those things are going to happen. But again, that doesn't mean imminent doom. But we do want to make sure that we think about, and again, this goes to the S&P 500 chart that we saw in the previous slide, is we don't want to forget things like 2008 or the tech bubble from 2000 to 2002, or the lost decade, or Black Monday, or the death of equities back in the 70s. Those are things that still happen in markets. And so we want to make sure that we're prudently positioned in the portfolios for ACF and how we look at markets overall. So bonds still have a role in your portfolio, in the investor's portfolio. Even though yields are down significantly, those bonds have that relative safety, right? So when things are going haywire in the equity markets, investors tend to flock to bonds and cash as a value, and that will help mitigate those downside returns by having, whether it's 20% in bonds in the long-term pools or 40% in bonds in the mid-term pools. That's exactly what the role of bonds is, even with those low yields. I mentioned a little bit earlier, international emerging market equity investing is not dead. So valuations are still look attractive relative to where U.S. markets are today. And so a big component of international returns over time is currency. And so the dollar has been very strong for a significant period of time. we would make the case that the overhang that we've seen over these foreign markets could have some big upside in the future here. We want to make sure that we still maintain thoughtful allocations to those spaces. One of our favorite bullet points: don't fall victim to the FOMO, or the fear of missing out. Stay diversified. Don't have S&P 500 envy. Don't expect that. Wow, we were up 19% or up 20%, but we could have been up 32% if we were just in the S&P 500. As I mentioned earlier, we believe that prudent diversification is that profession of humility. We don't know what's going to happen next year or the year after that. So thoughtfully diversifying across various investments is our way to mitigate risk to the greatest extent. And then the last takeaway here is know that we spend a considerable amount of time with the ACS Investment Committee ensuring that we are in the right asset allocation for the pool. So when we talked this year about not making too many changes. There's been this huge reduction in expected returns, but everything was down to such a strong degree that we agreed that there was not a lot of tweaking that needed to be done this year. You can find a way to shoot yourself in the foot by doing too much at times, and you should really just be standing pat. So again, those thoughtful conversations with the investment committee are happening to make sure that the pools that you are all invested in at ACF, whether it's the midterm pools, the long-term pools, the active pools, or the passive pools, have thoughtful diversification and are rebalancing around those long-term targets that we have to ensure that we're doing what we need to generate prudent risk-adjusted returns at the end of the day for your funds. I'm going to turn it back over to Coralie. And I really appreciate the time today. We always appreciate the ability to get on and talk with you all and share a little bit of thoughts on the markets every 6 months or so.
Thank you, Joe, and thanks to all for joining us. If you have questions, please contact us either by email or phone. And thank you again for being part of the Austin Community Foundation.